What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 20th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I want to spend some time to have a genuine one-on-one conversation with you guys and talk about the unfortunate state that we're in right now when it comes to crypto and the broader global equity market. I know a lot of people have gotten really excited about price action. A lot of people saying that the bottom is in, or that we're kicking off the next bull run here and now. Don't miss out on it. I want to go ahead and try to bring us, though, back to reality and not just observe what's happening in Bitcoin's price, but what's happening in the broader asset markets on a much larger scale, because it's going to help dictate the direction as to whether or not we go up or that we've still got a long way to go down. We got a lot of things to dive into today's video. If you guys happen to enjoy the rambling, drop a like and let's go ahead and kick off the conversation. So I want to go ahead and first focus in on Bitcoin here. Now, as we've had a couple of trading days here, really, and I think this will set the stage here for the conversation, we've had a lot of trading days where Bitcoin has been able to press up against that key 200-day moving average, or EMA. We've gotten above the standard moving average, but we're seeing very clearly that the market is seeing some hesitation. People are profit taking and keeping us at a neutral pace since back on January 13th, over a week, going against this indicator without being able to really make it support, showcasing that this could be a significant point of resistance, that there may not be further steam to fuel the rally higher. Now, this isn't exactly what's got me concerned. As you guys have probably seen over the past couple of videos, again, we are open to the idea that perhaps the bottom is in, but there are multiple steps we need to see in order to actually get bullish and believe that the trend is really ready to reverse. The first step is, of course, getting beyond the previous bear market resistance points, that 200-day moving average. This is the first time since back in March and April of 2022, almost an entire 9 months, right? Since we've had this opportunity to be able to test up towards these indicators, not to mention at a much lower price range. It should be much easier to get above that range if we've really found a bottom, not only blow past it, but almost have it where price doesn't even want to come down and test it, right? That the confidence and the optimism and the euphoria is so strong that we really are kicking off the next bull market. This is what happened both times, as we talked about, right? When we blew past the 200-day from the bear market lows of 2018, we didn't even come down and touch it, right? And on top of that as well, we had the same here, right? Once we had the deviation, which again was a fake out and led down to new lows in 2015, the next time around, we didn't even come down and touch that 200-day. The confidence was so strong. And that's the kind of price action we want to look here for Bitcoin. We want to see history repeating itself and giving us the signs that it's ready to start making the next move higher. Not just going off of some assumptions that we think the Fed is at a point where it can start to pivot, or that the low is in just because price is going up, right? These are not genuine reasons to get optimistic. And more specifically, if you come at it from a macro perspective, we need to really start considering that while inflation might be starting to cool down, perhaps price stability is coming back into play. Demand and supply are coming back in equilibrium. There is a much bigger problem that comes after stagflation, which is what we went through, and that is a unavoidable recession. Now, everyone has been talking about a recession, but because, as with each recession, things are different each and every time. Sometimes they take longer to manifest. Sometimes there are softeners that help to prevent recessions being so strong. And we'll talk about some of those things later on. The key thing we need to understand is that the equity markets are starting to signal a big red flag, a huge warning sign, according to the price action. Now, I could dive into the financials and talk about how corporate expectations for earnings are starting to go down over time as people are looking towards their forward earnings. I could talk about the actual quarterly earnings reports that came out, but you know what's much more efficient is just taking a look at the indices themselves and the stocks that make up the vast majority of market cap in the equity sector. Okay, now let's go ahead and do those two things. Let's just take a look at them. And again, while I will share my opinion, again, as we're having an honest conversation here, guys, I don't want it to be an echo chamber. There are some of you who are bears, some of you who are bulls. I just want you to take the data that I share with you here today with the indicators that we utilize, and I want you to just tell me what you feel about it, right? We'll spend some time going through each chart, and again, just take it one step at a time. So this is the NASDAQ, right? NASDAQ has, again, during the previous secular bull run, if we are still within that secular bull run, and this is one of the miniature recessions that people think it might be, right? The NASDAQ should be leading here. Technology stocks have been a leader for the last decade. Unfortunately, yet again, we are getting shot down at a consistent line of resistance. And on top of that, we didn't deviate above it like we did the past 3 times. So far, we are well below the 200-week moving average, the line of resistance, and on top of that, we have still yet, since as far back as August, since the Fed really made it clear that there was not going to be any pivot anytime soon, we have yet to come up and test that 200-day moving average. Now you tell me, does that look bullish or bearish? Think about that for a minute. Let's go ahead and take a look at some of the more defensive or more predictable sectors, like the S&P 500, taking the basket of 500 of the biggest companies out there in U.S. public markets. Yet again, coming up here to the 200-day, deviating slightly above it and falling right back down, just like we did here in December, just like we did in the early part of December, and also in August. Now, again, maybe we bounce up a bit, reattempt it, but the momentum clearly stalled here over the past couple days, and we faced 2 red down days right at that 200-day. So we're not seeing it blow right past it as a lot of the bulls claimed it would. The kind of signs that would signal that the Fed is pivoting, that it's got inflation under control, that we're going to be able to somehow have a soft landing or avoid a recession. That's the thing you'd expect after the equity markets have gone down to this amount of valuation decline, if we really are at the end of a bear market. But in reality, that 200-week is creeping up, the 200-day is squeezing in, and we are seeing a coiling of the broader stock market between these 2 moving averages. And so far, it shows that we are not out of the woods. We're playing tango here. And sooner or later, it's going to break in either direction. Okay? Now, again, I'll explain a little bit as we go throughout the video as to why I think it's to the downside. Last one here, the really defensive and best performing set of stocks, the Dow Jones, which are the 30 largest industrial companies in the United States that are publicly traded, yet again, coming up to the line of resistance around 34,300 that we've indicated here on the channel time and time again. We didn't even get a deviation this time. We weren't able to even get above that range. And we shot down yet again for 3 consecutive down days, back to where we were in the mid part of December, or where we were back in November. Okay, so all 3 indices here, again, you may have different opinions. You may see it just like I do. I hope that you guys are feeling somewhere in the middle, trying to think in your own light and stuff, right? And I don't want to come across as being a perma bear, right? As we talked about, guys, like if we can make this 200-day support and start setting in higher highs and higher lows, I'll definitely get a bit interested here. Like perhaps, maybe there are going to be some defensive plays that can stomach this recession. But all of the things that I'm seeing here in the indices are pointing towards a significant further decline, and that there isn't the kind of ample liquidity and optimism to really bet on either the fact that the Fed is going to pivot, or more specifically, in reality, that we're going to somehow be able to avoid a recession. When we take a look at some of the individual leaders, or more specifically the large cap stocks that make up the vast majority of valuation in the equity markets, that are going to have a major weight as to whether or not the general stock market goes up or down, right? Similar to how if Bitcoin goes down 10%, altcoins will likely go down just as much, if not more, right? Catch the gist here. We need to understand how these stocks are looking. Perhaps there are some market leaders. There are some stocks that are performing really well and are going to swallow up a lot of that market cap and, basically protect those who are more passive investors who have broad exposure. Oh, there's one simple way we can go ahead and do this. And we can take a look at the top 20 stocks here by market capitalization. And as you can see, these are very famous names, Apple, Microsoft, Google, Amazon, Berkshire Hathaway, ExxonMobil Corporation, UNH or United Health Group, Visa, Johnson & Johnson, TSM, Tesla, Nvidia, JP Morgan, P&G. All these are probably big names you've heard about or you probably buy products from. Okay? Now, again, as I mentioned earlier in the video, we could dive through the corporate earnings, right? We can do all those things. But again, I'm not a corporate analyst, right? And I'm not going to try to pretend to be a corporate analyst. I can read through corporate earnings to a degree and have some subjective opinions on it, but there are people who do this for their day job and are very rigorous, especially on these large cap companies. And they will do the job for me to understand the sentiment by how it reflects within price. All right. And this is a very big point I want to drive here, guys, because we are in, no matter if people feel this is like going to be a soft landing or recession of grand proportions, the market is hyper efficient at pricing this in. The consumer has been strong for the past year, but the question is whether or not the Fed has really got a grip on inflation. And if it does have a grip on inflation, there's likely a good chance that we're going into the next phase after stagflation, which is a recession. And that is not going to be good for equities because the Fed knows that they can't step in. This is the point that I think a lot of people don't get. The Fed may stop hiking rates, right? And they may stop their balance sheet reduction, right? But they are never going back for the next year or two. They are never going back into the environment where they kept injecting a lot of free money into the economy. And the equities are proving this to us. Let's take a look here at Apple, right? Apple definitely, the technology stocks have had a little bit of a bump up here over the start of 2023. See, Apple went up from around $126 to $135. But again, if you guys want to just take a look at the trend here, right, it was to whether or not we're out of the woods, take a look at Apple. We haven't even gotten above the 200-day moving average. Look back a couple months ago, back in August, before the Fed made it very clear, Apple was riding high. We had multiple deviations back above the 200-day moving average. We are at a much lower price, around $135 versus the $170, $180 price range we were at in 2022. And we are not even able to get up above that 200-day moving average. How about taking a look at the broader FANG stocks in Apple, right? This is one of our custom indexes here on the channel that we track. Well, take a look at it. Facebook, Amazon, Netflix, Google, or now Meta. Still not able to come up here towards the 200-week moving average after breaking down. Still setting in consistent lower highs and lower lows. Got to tell you guys, this is not looking good. If Apple is not able to get out of the woods, if with all of its stock buyback programs, which as we talked about in the previous video, are likely going to be drying up because of weakening corporate earnings, if that can't suspend Apple higher, that there are more outflows than that forced buy-side pressure from their relatively strong corporate earnings, that is a major red flag. And that signals that if the stock buybacks dry up due to lack of corporate earnings, there are no buyers at the table at these price ranges. Not to mention that investors likely don't see much growth potential in these big tech plays, that they are no longer going to be the market leaders, even if a bull market returns. So that's why this concept of just buy the dip, right? Just passive invest, right? DCA. You might be DCAing into plays that never come up to these valuations again, or at least for 3-5 years. Are we willing to stomach that? Or is it best to just wait in cash, remain patient, and not think with FOMO on every step? Again, these are the technology stocks, but they're not the only ones out there. There are a lot of other plays here. Again, there's NVIDIA and AMD, which are a little bit stronger. I wanted to mention them as well to be a bit neutral here. They've definitely been stronger since October against some of those plays, and many people believe that they may be still in a position, even after already expanding rapidly during the past decade, as semiconductors and graphics cards became more important, with more people building PCs, mobile phones, electric vehicles with self-driving functionality, all kinds of things that have driven demand for these companies, right? Still, they are not able to get above that 200-day that they haven't been able to get above since back in April. So this isn't really looking that good. But let's go ahead and step out of tech. Tech is a bit of its own kind of thing, right? It definitely is where a lot of the valuation is, but let's go ahead and take a look at the defensive sectors, get a view in detail about some of the Dow Jones and S&P 500 names that really lead the market. Procter & Gamble is one of the first companies here as we step into earnings season that gave us a little view as to how the market's doing. Now, earnings, if you just look at it here, look relatively fine here. But the market doesn't really trade so much on what happened over the past 3 months. A lot of that can get priced in. It's more about where the company itself projects it's going to be in the next coming months. And the thing is that if we take a look at price here, it tells us all we need to know about. We don't even have to dive in. You don't have to have accounting 101 degree to be able to see that the market did not like this. This is a clear falling star pattern, right, with a very tall wick on the top, where all those gains that were made from the gap down, right, we closed the gap, filled in that difference between the previous candle, and we rolled right back down to practically the lowest level throughout the entire trading day. And that's after a couple of consecutive days to the downside. Again, you can see this trend. We've deviated below the 200-day, And what happened every time we deviated back below that 200-day? We went down and set a new lows. This is not good price action to see. I'm just being realistic with you guys here, right? Because the thing is, people say, but Nick, if not the tech stocks, then maybe I'll buy defensive plays that pay good dividends because I have to fight inflation somehow. The problem with that thinking is that your dividends you're going to get are going to be completely outweighed by the decline from the purchase price of those equities. Dividends are kind of a way to hook people in, to keep you to be a long-term investor. And while it can be really great if you're buying companies that can stomach recessions and everything, at the same time, it does not mean you cannot make losses buying Procter & Gamble if you cannot wait for it to come back up to those original prices. And especially if the company is going through its late stage in the business cycle, that could still be a reason why you will never get back to your original investment, even with all those dividends. Take a look at AT&T. Take a look at a dozen of the legacy companies out there, right? Big technology names that were previously big, like IBM, right? That they may pay some kind of dividend, but it doesn't protect you from the annualized losses you're going to have on your stock positions. Johnson & Johnson, another defensive play, another dividend play out there on the market at its lowest level since October of 2022, dropping from around $180 down towards $169, deviating back below that 200-day. And what happened when we went below the 200-day last time? We came down, right back down to the low range here, around 159. And that 200-week is coming up very close here, folks. By the time we really get down here, there's a chance to potentially break that range. And we have not done so since March of 2020. And more broadly speaking, if we really zoom out here into the monthly, right? We usually don't get these kind of events, except for events like 2008. So this tells us here that the market, again, if we just take a look at that price action, the monthly candle, tell me whether or not that looks like the momentum of a bull market to you. It doesn't look like it to me. It looks like price is sitting sideways, markets are uncertain about the future, and are possibly likely pricing in a further decline in corporate earnings. Let's go ahead and take a look at a couple big names here. We'll wrap up our conversation. Walmart as well, big consumer play, down from its relative peak in November, $154 per share, down into the 200-day pocket at $138.83, the lowest level since October of 2022. Again, lower high than where we were back in April. And this is, again, one of those defensive plays. Walmart, again, I think not only pays a decent dividend, but on top of that as well, Walmart should be where people are rushing to, right? If this is just going to be an inflationary period. But here's the catch, again, that people aren't thinking about. It's not inflation that we need to be concerned about. The Fed is likely, what it's doing is starting to really cripple inflation. And that's the right thing to do. But there's another step to that. And that's the reflection of lower corporate earnings due to a recession. Got to beat it like a drum here, guys. Now, one of the things that's actually stood out to me that I don't think many people have talked about is the breakdown below the 200-day of United Health Group. Now, United Health Group is just one of these, I mean, I'll keep my personal opinions to myself and stuff. I know there might be somebody out there who work for a company or subsidiary of United Health Group. Look, the thing is, this is one of the kind of predatory large cap companies that's just acquire a whole range of the healthcare sector, make billions of dollars every year. But case in point here is that United Health Group, if you really just take a look at it on, say, the quarterly chart, I mean, this thing usually just goes up and to the right, up and to the right, up and to the right every single time. Now, usually when we come down to the 200-day moving average, buyers come in to save the day. The other day we faced resistance at the 200-day, and momentum has not only started to stall here, but potentially looks like it's ready to come down and test that 200-week, and potentially go down into a price pocket that we haven't seen since 2021. And this is one of the defensive stocks, a multi-$100 billion healthcare company that has made huge astronomical gains over the last few decades. And now it's starting to trend well below that 200-day. Now, last thing I want to talk about here is ExxonMobil. All right, ExxonMobil oil, one of the last few sectors that has some degree of optimism, but even it is starting to lose a lot of the momentum. Even it, after making such wild gains throughout the past year, going from $32 a share to $111 per share, is looking a bit overbought. It's looking a bit weak here, right? It's still well above that 200-day moving average, so it's definitely in the better camp of stocks. But again, We got to see whether or not we can get above those highs here in the near future, right? So maybe there's some light at the end of the tunnel. Maybe there are some plays here, some market leaders that will be able to survive or stomach this recession and potential downturn. But I got to tell you guys, the cards are stacked against the bulls right now, right? We were a bull for the last decade. We rode the wave of the secular bull market, guys. We made some great generational returns, not only in crypto, but also in equities as well. And the key thing we have to do here is we have to understand the dynamic that has changed. During the last decade, you were an idiot to fight the Fed and try to short the market. Instead, every time we got a 20-30% dip, should have gone long. That's at least what price says, right? And on the other end of the spectrum, when the Fed is in the driver's seat, when it is trying to cool inflation, and it is even willing, although it may not say it directly, to put the economy into a recession and cripple the labor market in order to calm consumer demand, in order to get back in equilibrium with supply, then we cannot fight against that. $130 billion of reduced money supply every single month. You can't go against that. No stock buyback program like Apple has, even one of the best, the biggest in history, is not saving Apple. And if that's not going to save Apple, forced buying of billions and billions of dollars from their cash pile they built up over the last decade, how is Bitcoin going to fare in this environment? That's the question I want you guys to ask yourselves. Whether you agree or disagree with me directly about analyzing Bitcoin's price or what's going on with specific individual stocks, we have to think about the next 6 to 12 months and the monetary inflows and outflows. And that's why I get real serious about it here, because it's a very cut and dry conversation, right? If there isn't going to be more inflows than outflows at these valuations, if expectations of corporate earnings are going down and we do meet to lower corporate earnings and therefore have less stock buybacks, less dividends, less reasons to be bullish and to provide that uplifting support, valuations are going to go down. I don't want to speak in absolute terms, right? Maybe these corporations do hold out, right? But I got to be honest with you guys. If I'm speaking not just with my words, but with my actions, we're still in cash. And being in cash has been one of the best choices we've made since back in August in 2022. And trust me, I have every incentive as a YouTuber to be overtly bullish and tell you to make a trade in every direction and do this and that. It's great for views, and there's a ton of ways through referral links to leverage trading exchanges where I can make my money, having you as investors get liquidated like a lot of other YouTubers do. But I don't do that because, to be honest, it's not moral. It's not what drives me or makes me happy as an individual. What makes me happy is getting it right and hopefully helping some of you guys along the way. While this isn't financial advice, I want you guys to be able to make the best decisions, be able to have that money there so that when we get that capitulation event, when we really get valuations coming back down to fair value or potentially below fair value and oversold, being able to really DCA in heavy, to really build those positions, or again, on another end of the spectrum, waiting for real signs of a trend reversal. If we can wait for one of those two things, lower prices or proper signs of trend reversal, we're going to be so much better off for it. And most importantly, you'll stress less. It's a big part of the investing game, is to make sure you have a method that you know works, that you can stay disciplined to, and it makes investing and trading so much easier. You don't always have to watch the charts. But it is good to watch DataDash so he can give you the summary of what's going on. Anyways, I hope you guys enjoyed my rambling. I know I went on a little bit longer today. If you guys like this kind of conversation, drop a like. And one of the best ways you can support the channel outside of just liking it is sending the video to family or friends, sharing it around Telegram groups, on Twitter. This is the kind of stuff I think people need to hear right now, because there's not enough of it right now. Every time there's a bump up, everyone gets excited. Everyone gets euphoric, of course, because we're afraid we're going to miss the bottom. But the best traders and investors don't try to catch the bottom. They try to make sure they know when the trend is really ready to kick off, when the rocket ship is ready to go. And I got to tell you guys, there ain't any fuel for the rocket ship right now. Fed ain't there. Stock buybacks are weakening. Risk sentiment is off, considering inflation. There's a lot of things we got to keep in mind. The increased expenditure on mortgage payments as a percentage of income. Americans racking up their highest level of costly credit card debt we have seen in decades. Not to mention just total record volume of credit card debt. But on top of that as well, when we take a look at our long-term data science models on players like CryptoQuant, which again, you guys can get access to in the description for free through our data science dashboard. If we think that we're out of the woods just yet, after a decade where we've had much worse with monetary easing, I think we've really got another thing coming to us. We gotta be watching these models, we gotta be analyzing what price is telling us, and prepare for the worst, not for the best. So, again, don't want to be too negative, but want to be realistic. And I hope this video proved valuable for you guys. Again, if you can, drop a like, consider subscribing if you haven't already, join the DataDash family. And until the next video, everyone, I'll see you all in the next one. Take care, everyone.